Charlie is like an assembly line, devouring. I mean, there's an engine of these things running through from the unread pile to the read pile. And I would estimate that he's reading more than 500 books. I think it's more than one a day. Now, he doesn't read the way we read. He's skimming a lot. And he's especially skimming a lot when, he's not, he finds the author rambling or whatever, and so he's trying to get the nuggets he wants. And they are in such a wide range. And, usually sometimes I'd go in on a Saturday evening or something to have dinner with him. And he'd be reading something about, global warming, some book on global warming. But one of the things Charlie told me many years ago, he said, in the investing business, it's really important to have somebody to talk to. You're not in an echo chamber and so on. So I said, oh, you mean like you have Warren? He said it wasn't always Warren, but I had somebody. And he said it's really important that you have somebody to talk to. And the person shouldn't be someone who reports to you. It should be kind of like a peer type relationship. And he told Lilu and me that he wanted us to get together for lunch once a week. He basically pretty much instructed us that the two of you, I want the two of you to meet once a month for lunch. And I told Charlie and Lilu, if Lilu wants to waste, an afternoon or hour or a month with me, I'm more than happy to do that. Yeah, and actually, so Charlie's absolutely right. Probably a huge portion of why I'm so ethical is because of self-interest, enlightened self-interest. So I think what people don't realize is most things in life function on trust. They don't function based on contracts. They function based on trust. And so if you become very trustworthy, it gives you a massive competitive advantage, a huge leg up in life. We see that in spades in Berkshire Hathaway. Berkshire Hathaway does all kinds of things where they just say something to someone and people will accept that. They don't need to have it in writing or anything like that. It just Warren's word is enough. And the other thing he said which he also said publicly, he said that our record would be a shadow of itself if we were not learning machines. So I think what happened is that C's taught them a lot of lessons. Blue chip stamps taught them a lot of lessons. Buffalo News taught them a lot of lessons. And diversified retailing taught them a lot of lessons. And even the textile mill and the insurance forest. So the important thing of these guys was they were learning machines and they absorbed. I am actually really happy that I went into the insurance business. It did not work out. I didn't lose my shirt. I got my money back. If I make a mistake and I get my money back, I'm really happy. Okay. And, but I learned a tremendous amount and I know I won't go there again. Been there, done that, got the t-shirt.
Why you're so extreme in sifting those people out?
Yeah, I think that's a great question. So my dad used to say that to have a great life, one needs one good wife and one good friend. Less is more, right? So, and I find with myself that I don't need a very large network of best friends or close friends. I find that if I spend time with myself, reading and thinking and doing my thing, I'm very happy. I don't need a whole lot. And so when I'm interacting with someone, I just want to make it so that those interactions, when I look back at them, that I enjoyed them. Anytime you can identify asymmetry in some action or something that you could take, you should go for it. So for example, Charlie told me, and I've seen it with him, is he likes to introduce randomness into his life. Sometimes when I meet him, from his coat pocket, he'll remove a bunch of letters he's received from people all over the world. There's a lot of people who write to him and whatever. And he'll go through a few letters and say, okay, this one, I'm going to have breakfast with this person. I'm just thinking, that guy's going to fall off his chair when someone from, Charlie's assistant contacts him or something. But Charlie likes that randomness. It has led to many great friendships and in some cases business partnerships for him. And again, there's no downside. And so I would just say that normally when I make investments in the fund, in fact, I've never invested more than 10% of assets in any one bet. So typically, ideally, it's kind of a 10 by 10 portfolio. There was a very good investor in India who passed away recently, Rakesh Jhunjhunwala, and he never managed money, outside money, and he had probably less than $500 to his name when he started his career. Didn't live that long, actually died in his early 60s. And when he passed away, his net worth was north of 6 or 7 billion. No fees. These are all, organic, and he didn't run companies. These are all, passive investments. But half that money was from one company. So he made a 4% bet a few decades ago in a company called Titan Industries in India, which ended up becoming more than half his portfolio. And Titan has done extremely well over the years, going to keep doing well. So if you think of someone like Rakesh's portfolio, let's say the other 96% of the portfolio went to zero, and he just hung on to his Titan, well, he still end up with like 3 billion or something, and so we start out, I would say, not that concentrated. But if the job is done right, you would end up very concentrated. So one of the things I always kind of scratch my head about is that, these very smart investors would buy MasterCard after the IPO. They might be more diversified than me. Maybe they might have 20 positions, which is fine, no problem. And so MasterCard is like a 5% position. And then it does really well, and it becomes a 25% position or a 30% position because it's done so much better than everything else. And like Jack Nicholson said, they can't handle the truth. And in some cases, their grandmothers took away certain body parts when they were 13. And so, they're done. Well, it gets to 15% and they trim. It gets to 17, they trim again. And it never gets to even 20%, right? And so to me, I really scratch my head about that. So yes, you get a diversified portfolio, but you're cutting the flowers and watering the weeds. And that's not what Rakesh Jhunjhunwala did, and that's not what Warren Buffett did. So I think that if an investment manager has done the job right, they're going to end up with 80-90% of their net worth in one stock. And the way they should think about that stock. So if we think about the Walton family and their ownership of Walmart. So Sam Walton passed away a long time ago. There are no Waltons running Walmart. There might be a couple of them on the board, but they really don't have much influence about the way Walmart runs. But almost all the Waltons are extremely concentrated with 90% or more of their wealth in just one stock, right? So you don't need to be a founder or a founding family to have that concentration. So my friend Nick Sleep, for example, hung up his boots. He had 3 stocks, and one stock, Amazon, became 80%. Because it did so well and the other 2 weren't slouches, but it did better than Berkshire and Costco. And the way to think about Amazon 80% is the way the Walton family thinks about Walmart stock when it's 80 or 90%, which is you are effectively like the founding family, and it's a great business, and you just leave it alone. But this is hard. This is hard for most people to do, and I think I have a lot of respect for Rakesh because of what he was able to do on that front.